How does a global manufacturing giant ship fewer physical products out the factory doors, yet somehow, manage to spike its core profits by 14% in a single quarter?
It is honestly wild when you look at it on paper.
Right. Welcome to Talk Tickers, where our mission is tearing apart corporate earnings to separate the operational reality from the financial engineering. Today, we are taking a deep dive into Ardagh Metal Packaging, ticker AMBP, and their Q2 2026 earnings.
And this one is a really fascinating case study for retail investors.
It really is, because when you dig into this transcript, you are immediately confronted with this massive volume paradox. Shipments are down, but profitability is just through the roof.
Yeah, which usually sets off alarm bells, right?
Exactly.
Yeah.
If you hold AMBP or you're evaluating the packaging sector as a whole, you really have to look past the surface level assumption that this is just a company bending metal into standard cylinders.
They really aren't that anymore.
No, they have fundamentally repositioned themselves. Think of them as like the bespoke tailors of the beverage aisle.
I like that analogy.
Yeah, I mean, they are outfitting the fastest growing categories. Your energy drinks, premium sodas, hard seltzers in these high margin, sleek aluminum suits, essentially.
Right, they aren't making your grandmother's soup cans anymore.
Exactly. They have spent the last decade, and I mean a literal $2 billion in growth capital, moving away from legacy commodity packaging. They are in the premium beverage fashion business now.
And that decade-long $2 billion transformation, I mean, that is literally the only lens through which this quarter makes any sense for you as an investor.
This is the whole story.
Yeah. CEO Oliver Graham framed this entire earnings call around their 10-year anniversary. 10 years of integrating three completely disparate regional businesses into one unified global network.
Which is not easy to do in heavy manufacturing.
Not at all. And when you inject $2 billion into a manufacturing footprint, increasing your total capacity by over 30%, you completely alter your margin profile. You change your operating leverage.
So you aren't just relying on churning out billions of identical cheap cans to make a penny on each one.
Exactly. You are no longer highly dependent on sheer volume to drive the bottom line. You are suddenly dependent on the product mix.
Right. What kind of cans you're selling, not just how many.
Precisely. And that altered margin profile is exactly what we saw mispriced by the market heading into this quarter.
Well, let's hit the headline numbers then, because the adjusted EBITDA beat is, frankly, staggering.
It really was a huge beat.
We are looking at $240 million in core operational profit for Q2.
Which is massive for them.
Right. That 14% year-over-year increase just absolutely obliterated management's own guidance.
Yeah, they had projected, a midpoint of $215 million?
Exactly, 215. So beating your own internal projections by $25 million in a mature, capital-intensive manufacturing business, usually, that implies a massive surge in demand.
You would think they were running factories 24/7 to meet a huge order spike.
Right, but global shipments actually decreased by 1% year over year. So I was looking at this $25 million beat, and frankly, I have to push back here. It looks like a bit of a mirage to me.
A mirage? How so?
Well, management admitted on the call that over half of that beat is driven by this, quote, metal pricing timing impact.
Right. The LME lag.
Yeah. Essentially, from what I understand, they are buying cheaper aluminum on the commodity markets today, but selling finished cans based on last month's higher pricing contracts.
Yes. That is technically what's happening.
So isn't that just a temporary accounting quirk? Like it's a byproduct of pass-through lags, not a permanent operational win? If I'm an investor, how do I trust a beat built on an accounting illusion?
I hear you. But dismissing it as just an illusion or mirage kind of ignores the mechanics of how commodity pass-through contracts function in this entire industry.
Okay, break that down for me because it sounds like a loophole.
Well, it's not a loophole, but you are right to separate it from pure operational growth. Basically, packaging companies use these multi-year contracts with beverage brands, right? And these contracts include automatic escalators and de-escalators based on the London Metal Exchange or LME aluminum prices.
So if the price of raw aluminum goes up, AMBP just passes that cost onto the beverage brand.
Exactly. The mechanism is designed specifically to protect AMBP's margins from raw material inflation.
Okay, that makes sense. But where does the $25 million windfall come from then?
It comes from the lag. The pricing adjustments in these contracts are typically backward-looking. They often use, say, a 30 to 90-day average of LME prices to set the price of the cans they sell today.
Oh, I see.
Right. So when aluminum prices drop sharply, which they did heading into this exact period, AMBP's spot-on cost for raw aluminum billet falls immediately. They're buying the raw metal cheap today.
But they are still billing their customers based on the more expensive aluminum from 3 months ago.
Exactly. Their revenue for the finished cans they ship out the door today is still calculated on the higher LME average from the previous quarter. So you get this immediate margin expansion.
Wow, okay. So it's like finding a $20 bill in your winter coat.
That is a perfect way to put it.
I mean, it's really nice to have today, and it technically boosts your net worth, but you definitely can't build a long-term household budget around finding $20 bills in your laundry.
Right. It is an accounting reality. Cash is hitting the balance sheet, but it is highly cyclical. Management was actually entirely transparent on the call that this specific tailwind is going to reverse in the second half of the year.
And we are definitely going to talk about that reversal in the guidance section. But transparency doesn't change the fact that if you strip out that favorable lag, they barely cleared the top end of their original guidance rather than, absolutely crushing it.
That is a very fair assessment.
So the fundamental story here isn't really the global profit number. It is the radical divergence in their regional performance.
Yes. The regional split is where the real deep dive starts.
Right, because to understand why overall volume dropped 1% while profits held up, we really have to isolate Europe.
Europe is the MVP right now.
Europe is single-handedly carrying the balance sheet. I mean, look at these numbers. Revenue hit $698 million, which is up 10% on a constant currency basis.
And just for the listener, constant currency just means we are stripping out the noise from foreign exchange rates fluctuating. It gives you the true operational growth.
Exactly. Thank you. And then adjusted EBITDA in the region skyrocketed 36% to $105 million.
A 36% jump in core profit is huge.
It's massive. And that profit acceleration was actually backed by real volume, a 5% increase in physical volume, driven entirely by carbonated soft drinks and energy drinks.
Yeah, Europe's outperformance is honestly a direct result of aggressive regulatory and consumer shifts.
The green transition, right?
Exactly. The shift toward the aluminum substrate in Europe is accelerating. The European Union's packaging regulations, particularly their massive push for infinite recyclability, are actively penalizing single-use plastics.
Which makes sense. Europe has been leading that charge for a while.
They have. But what's really interesting is that it's also making glass prohibitively expensive.
Wait, really? Glass? I thought glass was considered sustainable.
It is recyclable, sure, but think about the transport and emission standpoint. Glass is heavy. It costs a fortune in diesel to truck it around, and the furnaces to melt and form glass use a catastrophic amount of energy compared to aluminum.
Ah, right. And aluminum is so light.
Exactly. Plus, aluminum boasts this incredible recycling loop. A can on a supermarket shelf today can be bought, recycled, melted, and put back on a shelf as a brand new can in 60 days.
60 days? That is crazy fast.
It is. And doing that uses a tiny fraction of the energy required to produce virgin aluminum. So beverage brands are reading the regulatory writing on the wall.
They don't want to get hit with carbon taxes or plastic packaging penalties.
Precisely. And Oliver Graham pointed out a massive shift in their innovation strategy on the call.
What did he say?
Well, historically, beverage companies used to launch their premium products in glass first, right? To establish that high-end brand equity. And then maybe a few years down the line, they would cascade that product into a can format for the mass market.
Right. You think of a premium imported beer or a high-end soda, you picture a glass bottle.
But not anymore. Now, innovation is happening simultaneously across glass and metal, or in many cases, they are entirely bypassing glass altogether.
Wow. So the aluminum can is literally becoming the primary vehicle for premium beverages in Europe.
It is. It's not the cheap alternative anymore. It's the standard.
Okay, so that structural shift toward aluminum completely explains the European demand. But we have to look at the other side of the Atlantic to find the source of the global volume drag.
Yeah, North America was a very different story.
It really was. North American shipments dropped 5% for the quarter. Now, management claims this was entirely in line with their expectations due to, quote, contract resets and some early quarter metal supply chain choke points.
Yes, the classic transition year narrative.
Exactly. Let's dissect those contract resets first. Because in my experience, calling it a transition year is often just management speak for we are losing market share.
It certainly can be, yeah.
Right, because in these multi-year packaging deals, you have strict take-or-pay clauses and tiered pricing based on volume commitments, right?
Correct. The beverage brand commits to buying a certain number of cans, or they pay a penalty.
So when a massive contract expires in an inflationary environment like we have now, beverage brands are consolidating their SKUs. They are forecasting lower volumes to protect their own margins.
That's exactly what's happening. The brands are getting nervous about consumer spending.
So my question for you is AMBP actively walking away from low-margin legacy volume during these contract resets? Or are they just getting outcompeted by the other giants like Ball Corporation and Crown Holdings on price?
It's a great question, and from the data in this call, it is predominantly the former. They are choosing to walk away.
Really? They are voluntarily giving up volume?
Yes. Think back to that $2 billion investment we talked about. When you have spent $2 billion retooling your entire factory network for specialty formats, you do not want your expensive new production lines clogged up with low-margin, standard 12-ounce commodity cans.
Oh, I see. The opportunity cost of making a cheap can is too high now.
Exactly. Contract resets are the mechanism by which AMBP optimizes its customer portfolio.
So they're basically firing their bad clients.
In a polite corporate way, yes. If a legacy brand demands deep price concessions to renew a massive order of just standard basic cans, AMBP has the strategic luxury to walk away.
Because they have someone else lined up to buy that factory time.
Right. They know they have a massive backlog of demand from premium energy drink brands who are more than willing to pay higher margins for the specialty, sleek formats.
So that 5% volume drop in North America, it's just the mathematical result of shedding that lower tier volume.
It is. It's a strategic volume drop. And furthermore, the supply chain choke points they mentioned were highly specific and temporary.
What exactly happened there? I hate when management just says supply chain issues without detail.
They actually did provide detail this time. They experienced a constrained availability of very specific aluminum coil gauges that were required for certain North American lines early in the quarter.
So they just literally couldn't get the specific thickness of metal they needed?
Right. But management confirmed that the supply normalized rapidly, meaning the Q2 volume drop was artificially depressed by raw material constraints, not a pure lack of end consumer demand.
Okay, I buy the optimization argument for North America. That actually makes a lot of strategic sense. But I have to tell you, that thesis completely falls apart when you look at Brazil.
Brazil. Yeah, that was a tough print.
Tough. A 15% drop in shipments in a single quarter is disastrous, especially considering Brazilian shipments were actually up 14% in Q1.
The volatility is intense.
A 29-point swing in volume in 3 months. That points to a market that is either fundamentally broken or wildly mismanaged.
It definitely looks terrifying on a spreadsheet.
Well, management blamed the, post-COVID consumer recovery stalling out, and they said a leading competitor flooded the off-trade market with World Cup promotional activity. But, macroeconomic headwinds and competitor promotions are known variables in this industry.
They are, but Brazil is unique.
But a 15% contraction, that suggests their specific customer base in Brazil is just getting slaughtered at the retail level.
Well, you are actually hitting the nail on the head right there.
Yeah.
But the Brazilian market structure requires a totally different analytical framework than what we use for North America or Europe. It is a volatile emerging market with a highly sensitive consumer discretionary threshold. When inflation and interest rates spike in Brazil, which they have, the consumer doesn't just trade down to a slightly cheaper brand.
What do? Stop drinking beer.
Sometimes. They either exit the category entirely, or, more importantly for this earnings call, they shift their buying habits drastically. They move from on-trade consumption, meaning drinking in bars and restaurants, to off-trade consumption, which means buying multi-packs in supermarkets to drink at home.
Because it's way cheaper to drink at home when inflation is crushing your wallet.
Exactly. So what happened in Q2 was this perfect storm of competitor strategy and channel shifting. A dominant domestic brewer, which, reading between the lines, we can infer is AmBev, given their massive market share down there, chose to aggressively subsidize volume in the supermarket channel.
So they just slashed prices to clear out their own inventory.
Right. They slashed prices on their standard cans in grocery stores to capitalize on sporting events and just force volume through the system.
And because AMBP's primary customers in Brazil are the premium brands that compete against that dominant brewer, those premium brands saw their volume just evaporate overnight in the grocery aisle.
Precisely. Consumers walked into the supermarket, felt the pinch of inflation, and opted for the heavily discounted domestic beer instead of the premium brand.
Wow. So when the market leader initiates a price war in the off-trade channel in a macro-constrained environment, the premium brands suffer immediate severe volume compression.
Exactly. AMBP's volumes are intrinsically linked to the market share of their specific beverage partners. If their partners aren't selling beer, AMBP isn't selling cans.
That makes total sense.
And just to add one more layer of bad luck to the quarter, one of AMBP's major customers in Brazil took scheduled downtime for facility maintenance during this exact same window.
Oh, man. So you add all that up and you arrive at the 15% contraction.
Right. It is highly volatile, yes, but it is not indicative of a structural failure of AMBP's actual manufacturing assets. It's a reflection of emerging market consumer sensitivity.
Okay, that context helps a lot. Which brings us, really, to the core operational shift that essentially saved the entire quarter for them.
The specialty cans.
Yes. This is what allowed them to post a 14% profit increase, despite the North American optimization shedding volume and that absolute bloodbath in Brazil. The transcript highlights that over 50% of AMBP's global volume is now comprised of specialty cans.
Which is an incredible milestone for them.
It really is. We are talking about the sleek, slim, non-standard formats. The unit economics here are just fascinating to me.
Break down the unit economics for the listener because it's the key to the whole stock.
Well, a specialty can often uses slightly less total raw aluminum per fluid ounce of capacity, right? Depending on the exact gauge and height.
Yep, slightly less metal.
Yet AMBP can charge the beverage brand a massive premium for that can. And the beverage brand happily pays that premium because a sleek can allows them to position the drink as a premium lifestyle product.
Exactly. It looks cool. It feels premium in your hand.
Right. So the beverage brand can charge the retail consumer $3 for a sleek can of sparkling water or energy drink instead of $1.50 for a standard clunky can.
That dynamic is the core investment thesis for the entire packaging sector right now. And AMBP crossing that 50% threshold is a massive, massive milestone.
It validates the $2 billion they spent.
It does, because the margins on a sleek format are structurally higher than a standard 12-ounce can because of that exact price-to-material ratio you just explained.
Less metal, more money.
But it goes even deeper into the manufacturing efficiency itself.
Oh, really? How does it affect the factory floor?
When a facility is dedicated entirely to specialty formats, the changeover times between different label printings and subtle size variations are heavily optimized.
So they aren't stopping the machines as often?
Right. You are generating higher revenue per minute of line time. So by shedding the low-margin standard volume in North America and scaling up the specialty volume globally, AMBP is finally proving that their network transformation is yielding the operating leverage they promised investors a decade ago.
So even in a quarter where the actual physical global volume shrinks by 1%, the richness of the product mix drives the EBITDA up 14%.
Exactly. Mix over volume.
It's a brilliant pivot. But we have to talk about the future because the market is forward-looking. And management's guidance for the rest of the year presents a massive contradiction that I think retail investors need to understand.
The guidance was definitely a mixed bag.
Extremely mixed. On one hand, they upgraded their full year 2026 adjusted EBITDA guidance. They bumped it up to a range of $775 million to $790 million.
Which looks great on a headline.
It does. But on the other hand, they are warning pretty explicitly that Q3 EBITDA is going to dip significantly. They are projecting it to fall to between $200 million and $210 million.
Yeah, that Q3 number is a reality check.
It is. Because the bill is finally coming due for that Q2 metal pricing timing lag we talked about earlier. They literally stated on the call that about 1/3 of that favorable timing impact from Q2 is going to violently reverse and become a negative headwind in the second half of the year.
Right, and that reversal is purely mathematical based on the contracts.
Explain how it reverses, just so we're crystal clear.
Sure. As the LME aluminum prices stabilize or begin to creep back up, AMBP is suddenly going to be buying raw aluminum at higher spot prices today.
Okay.
But because of that trailing average contract, they are forced to sell the finished cans to the beverage brands at the lower pricing from the previous quarter.
So the exact opposite of the Q2 windfall.
Exactly. It compresses the margin from both sides. It's the painful side of the cycle.
But wait, you have to separate the accounting headwinds from the actual operational headwinds here too, right?
Yes, definitely.
Because management is also bracing for a highly tangible, mid-single-digit million-dollar hit to freight and direct material costs in the second half. This isn't just an accounting lag.
No, this is real-world inflation biting them.
And this is where macroeconomic geopolitics directly impacts a packaging company's balance sheet. They connected this freight inflation explicitly to the conflict in the Middle East.
The ripple effects of global shipping.
Yeah, we are seeing the direct results of the Red Sea shipping crisis and the resulting spike in global oil prices. For a company like AMBP that relies heavily on moving raw aluminum billet and finished pallets of cans across the globe, higher diesel prices and elongated shipping routes immediately bleed into their operating expenses.
They absolutely do.
So just to summarize the Q3 setup, they are facing an accounting reversal on their metal contracts, real-world inflation on their logistics, a flat transition year in North America, and a highly unstable Brazilian consumer market.
Which sets the perfect stage for what was probably the most aggressive capital allocation decision in the entire earnings call.
Oh, exactly. I have to push back incredibly hard on their CapEx strategy here because it blew my mind.
I knew you were going to bring this up.
I have to. Despite outlining all of those immediate margin compressing headwinds for Q3 that we just listed, they announced they are actively increasing their total capital expenditures by $40 million.
They are leaning in.
They are bumping the 2026 total up to $240 million, specifically to upsize factory capacity projects in Spain and the United Kingdom. I mean, if your margins are getting squeezed by Middle East oil shocks and you are heavily reliant on an accounting quirk for your first half profit beat, sinking an additional $40 million into physical concrete right now seems borderline reckless to me.
Reckless, that's a strong word.
Shouldn't a conservative management team be hoarding cash, aggressively paying down debt, and defending the balance sheet until the freight inflation subsides? Why build more factories right now?
I get the hesitation, I really do. But if you manage a capital-intensive manufacturing business quarter to quarter like that, you will inevitably destroy long-term shareholder value.
How is protecting cash destroying value?
Because of the timeline. The lead time on expanding a facility, installing new lines, and getting them certified for food-grade beverage packaging is measured in years, not months.
Okay, that's true. It takes a long time to build these lines.
Right. You cannot wait for the macro environment to look perfect before you break ground. By the time the macro environment is perfect, you are 3 years too late to capture the demand.
I see your point.
The decision to inject an additional $40 million into Iberia and the UK is driven by the fact that they are physically stocked out of capacity in those specific regions.
Right.
They literally cannot produce enough cans to meet the demand generated by the glass to aluminum transition we discussed earlier.
But building capacity without guaranteed offtake, I mean, that is exactly how packaging companies go bankrupt during cyclical downturns. They build too much, demand dries up, and they are stuck with the debt.
Which is precisely why Oliver Graham explicitly noted that this CapEx increase came only after, quote, constructive commercial engagement with our customers.
Meaning they already have buyers lined up.
Exactly. In the packaging industry, you do not approve a $40 million capacity expansion on speculation. You just don't. You do it because you have signed binding multi-year take-or-pay contracts with major beverage brands that guarantee a minimum return on that invested capital.
The take-or-pay contracts again.
Right. The beverage brands in Europe are legally committing to buy the volume that these new lines will produce before the lines are even built.
Yeah.
If AMBP refuses to build the capacity out of fear of short-term freight inflation, those beverage brands won't just wait around.
They will just sign contracts with Ball or Crown.
Exactly. And AMBP will permanently forfeit that market share in Europe. So the $40 million is defensive as much as it is offensive. It protects their dominance in a rapidly expanding European market.
Okay, when you put it that way, with the take-or-pay contracts backing the expansion, it makes a lot more sense. It's not a speculative gamble.
Not at all. It's executing on guaranteed demand.
So synthesizing all of this, the thesis for the retail investor holding AMBP right now is entirely predicated on patience.
100%.
You are not buying a clean 2026 growth story. 2026 is messy. It's bogged down by contract resets, timing lags, and geopolitical fight inflation.
It's a transition year in the truest sense.
Right. You are basically buying a 2027 turnaround story. Management laid out the roadmap. The North American resets will be fully digested by then. The new European capacity will come online. And they explicitly stated they have secured additional filling locations that will allow North American growth to match or beat the industry average by 2027.
They are very confident about 2027.
This year is just about surviving the transition and optimizing the mix. But my question to you as an expert, is the promise of a 2027 rebound enough armor to protect a retail investor's portfolio from the immediate shrapnel of Q3 margin compression?
Well, the transition year narrative is only viable for investors if the company has the financial safety nets to prevent catastrophic downside while you wait.
And do they have those nets?
Yes. AMBP has two exceptional safety nets that drastically alter the risk profile of holding the stock through a volatile Q3.
Let's hear them.
The first is their capital return program. They confirmed on the call that their quarterly ordinary dividend remains unchanged at 10 cents per share.
Okay, so a 40-cent annual dividend.
Right. You're capturing a significant yield just to sit on your hands and let management execute the 2027 strategy. You get paid to wait.
A dividend is great, I won't argue with that, but it can be cut if operational cash flow creators, we've seen it 100 times. To me, the far more compelling safety net in this transcript is their energy hedging program.
Yes, the energy hedging is phenomenal.
It really is. We have seen European manufacturing companies completely obliterated over the last 3 years due to the volatility in the TF natural gas markets and electricity grid pricing.
The energy spikes in Europe have bankrupted companies.
Exactly. And melting raw aluminum, forming it into ultra-thin cylinders, and baking the internal chemical coatings that requires immense continuous baseload power. If a geopolitical event spikes European natural gas prices by 50%, an unhedged packaging facility becomes unprofitable literally overnight.
It's a massive systemic risk for anyone operating in Europe.
But the mechanics of AMBP's hedging strategy are incredibly robust. They utilize over-the-counter derivatives and forward contracts to lock in their megawatt-hour costs well into the future.
And what were the exact coverage numbers they gave?
Management detailed that they are over 85% covered for their energy requirements for the remainder of 2026.
Wow. 85%.
Right. So if European energy markets go completely haywire tomorrow, 85% of AMBP's operating costs are mathematically insulated from the shock.
That is huge for margin stability.
It is. But the true strength is the duration of the hedge. They're approximately 80% covered for 2027 and nearly 70% covered all the way out to 2028.
That level of forward coverage is extraordinary in this current macro environment.
They are essentially buying an insurance policy on their operating margins. It removes the largest systemic risk of operating heavy manufacturing on the European continent. It provides absolute cost visibility for the next 2 years, ensuring that the elevated margins they are generating from the specialty can mix won't be suddenly eroded by a spike in utility bills.
It lets them sleep at night, and it should let investors sleep at night too.
Absolutely. But there is one more variable on the balance sheet that we have to evaluate before we wrap this up, and it is a massive fundamental catalyst that rarely happens in this sector.
You were talking about the Boston Beer litigation.
I am. It is the ultimate wild card for their balance sheet.
It really is. It's a fascinating subplot to this whole company.
For those who haven't followed the saga, in 2022, AMBP sued Boston Beer for breach of contract, and this stems directly from the hard seltzer boom and the subsequent bust.
Which was a wild time in the beverage industry.
Oh, it was chaos. In 2021, beverage companies like Boston Beer, who makes Truly, panicked. Demand for hard seltzers was exploding, and there was a literal global shortage of aluminum cans.
Nobody could get cans.
Right. So to secure their supply chain, Boston Beer signed massive take-or-pay contracts, legally obligating them to purchase minimum volumes of cans from AMBP.
And we know how ironclad those take-or-pay contracts are.
Exactly. But when the hard seltzer trend crashed back to earth shortly after, Boston Beer was left with contractual obligations for hundreds of millions of cans they no longer needed, so they breached the contract.
Which you just can't do in this industry without consequences.
No, you can't. The legal mechanics of take-or-pay contracts are ironclad for this exact reason. The manufacturer, AMBP in this case, allocates capital and dedicates line time based on that volume commitment. When the brand walks away, the manufacturer is legally owed the lost profit margin.
And the courts agreed with AMBP.
They did. The transcript highlights that AMBP recently won an amended final judgment of $190 million on a pre-tax basis.
$190 million.
Yeah, and that actually includes $15.5 million in pre-judgment interest.
We really had to put that number into the proper context for the listener.
Please do, because it's a huge number.
Well, AMBP just celebrated a phenomenal expectation-crushing quarter where their total global adjusted EBITDA was $240 million, right?
Right.
A $190 million legal judgment is equivalent to nearly an entire quarter's worth of global profit just dropping onto the balance sheet out of thin air.
It's a massive cash injection. Now, to be fair, Boston Beer has posted a bond and filed a notice of appeal, so this cash is not instantly accessible to AMBP today.
Right. The appeals process could easily take years.
It could, but the present value of that judgment is a massive hidden asset. It is a lottery ticket where AMBP already holds the winning numbers. They just have to survive the bureaucratic delay to actually cash it.
And if and when that judgment survives appeal, an infusion of nearly $200 million allows AMBP to instantaneously deleverage their balance sheet.
Pay down that debt.
Exactly. Or they could fund an entire year's worth of global capex without tapping the debt markets at all. It dramatically lowers their long-term cost of capital.
It gives them so much strategic flexibility. So taking all this into account, the specialty can margin expansion, the European regulatory tailwinds, the impenetrable energy hedging, the impending Q3 freight inflation, and this Boston Beer wildcard, we have to issue a verdict for the retail investor.
Where are you landing on it?
My stance here has to be firmly, cautiously bullish for the long term, with the explicit caveat that Q3 is going to be incredibly choppy.
I think that is the most rational take.
The structural shifts in their favor are permanent. The victory of aluminum over glass in Europe is locked in by regulation. You can't reverse that.
Yeah.
The consumer preference for premium, sleek formats is accelerating globally.
Right. Those are permanent tailwinds.
And the Q3 headwinds, the reversal of the metal timing lag and the Middle East freight inflation, those are cyclical and geopolitical. They will definitely cause margin compression in the next 90 days, but they do not break the fundamental unit economics of the business.
I agree completely. You are evaluating a company that has successfully exited the low-margin commodity rat race and positioned itself at the absolute choke point of premium beverage growth.
They are the toll booth for premium drinks.
Exactly. The transition year is painful to hold through, but the architecture of the 2027 rebound is already built and fully funded.
It just requires the discipline to look past the immediate quarter and wait for the $2 billion network transformation to run at full capacity. That is the true takeaway from this AMBP earnings call.
Patience is key here.
It always is. But before we wrap this deep dive, there is a massive industry-wide implication buried in this data that extends far beyond Ardagh Metal Packaging.
Oh, what are you looking at?
Well, we established that specialty, sleek cans have officially crossed the 50% volume threshold for AMBP. The premium format is no longer a niche alternative. It is literally the new global standard.
Which forces a strategic reckoning for the entire beverage ecosystem.
Exactly. I want you, the listener, to think about this. You have to ask yourself, are standard, clunky 12-ounce cans going the way of the dinosaur?
It certainly looks like it.
And as consumer preferences and strict sustainability regulations rapidly force a shift towards slim-profile aluminum, what happens to the legacy beverage companies holding billions of dollars in obsolete glass bottling plants and standard can-filling lines?
They're going to be holding a lot of stranded, useless assets.
Right. The packaging manufacturers like AMBP are adapting, but the beverage brands that cannot afford to pivot their own manufacturing infrastructure fast enough are going to be left completely stranded.
It's a huge structural risk for the legacy beverage names.
It absolutely is. Thank you for joining us on this deep dive under the Talk Tickers banner. Evaluate your risk, check the forward guidance, and we will see you on the next one.